And when that happens, it tends to suggest that it's going to continue doing so. And it's been tracking it since the get-go, and we've been along those lines. So we've remained pretty defensive in our worst 6 months position. I know with you guys in this room and Mr. Top Steps people, you guys are real, day traders and quick intraday traders. But the stuff that we do is a little bit longer timed. But I can tell you that I think for some of your trading profits, you can find a place in your, more solid, stayed portfolio to try some of the things here. There's also a bunch of trading ideas that we have. And as Danny reminds us all to read the Almanac every day, even look in the back if you haven't. The intraday trading patterns continue to persist. I mean, we had that sell off this morning. Today's a different kind of day because we have a lot of news out there with this impeachment stuff, which remains to be seen if it'll stick. But let's look at what I brought to present, and I'll try to run through it quick, and then we can get into some questions because I'm going to have to flip back and forth with the screens here. But this whole sell-off we're setting up, it's right into our wheelhouse. So again, October phobia. Great to be here. Good time for us with the Almanac. But don't fear October. This is setting us up for a real decent buy for the best 6 months. And I think we could probably make a new high by year end. And you guys will have fun trading this volatility right here. Hopefully you guys were expecting some of it also, especially you readers of the Almanac. So quick disclaimer, not offer to buy or sell anything, information purposes only. Well, not offer to buy or sell any securities. And informational purposes only. Past performance not guarantee. Use your due diligence, your heads, etc., so forth. Consult with Danny on everything. Just to look at the history that we've been at. We've been around for 53 years. I am 53. Amazingly, I've been doing this since I was born. Actually, Yale started the book when I was in utero. So I was born, bred, weaned, raised on it. For anyone wondering, the big guy is still around. He's going to be 96 on October 23rd. Him and mom are in a home being looked after with great care, the Jewish home at Rockley. I owe them a visit, but I've been traveling and busy. And some of the places I get to see, I have scheduled to be on CNBC Power Lunch this afternoon to discuss some of this stuff, unless I get bumped from some presidential announcement or something political. But I'm planning to be down there around 2:30 Eastern time. So just moving along, since you guys kind of have a understanding of who we are and what we do, but our philosophy, and I think this is important, and what the Pitbull was telling Danny way back, the old Santayana quote that those who fail to remember the past are condemned to repeat it. We think that those who study market history are bound to profit from it, and using history as a guide, but not gospel, is pretty important from our friend Sam Stovall. So that guide has been following quite closely this year, and you're going to see that shortly. Our process, we look at all these trends, and please send them in. If you guys have anything of note or interest, we've been taking reader suggestions, questions, comments, corrections since day one. So we publish all that annually in the Almanac. The 2020 Almanac is on the press. Should be in by the end of this month. And we update all that monthly and weekly in our newsletter on the website at stocktradersalmanac.com. I got a free offer for a free month for everybody coming up on a slide. It's pretty easy. But we use all this information to construct portfolios. Not as much intraday trading as many of you all do, but I'm sure you guys have some other portfolios. And when we get into stocks, we look at fundamentals and technicals. I look at internals, which have been so far okay this year. We'll see how that breaks down. I look at them on a weekly basis as well, not just the daily stuff, to sort of weed out some of the noise, and there's plenty of noise these days. Sentiment, of course, investors' intelligence, and Bullish Advisors has gotten quite a bit frothy lately. Put call hasn't given us a whole lot of actionable readings recently, again, on the more weekly basis. Monetary and government policy has been driving the news flow, and current trends in the economy is something we look at always. but our basis is cycles, seasonalities, recurring patterns, market trends with frequency and magnitude. So again, if you're looking to get some great ideas to trade around or some stuff for your investment portfolio, try us out for free, stocktradersalmanac.com, 30 days free / 30 days free, pretty simple. Or if you want to take us up on an offer for a really incredible value subscription, $150 for a year, $250 for 2 years. You get a free almanac every year. I'll send you 2019 now if you don't have one while supplies last. And that's the offer. We'll check that again later as a reminder. 4-year cycle. Everyone's pretty much freaking out right now, but let's remember this is a pre-election year, and if things were that bad, would the market be up 50% since the president Trump took office? And we have been tracking these gains. We're still up, about 15%, at least as of yesterday's close, on the Dow for the year. NASDAQ, not quite up at 28.8 as it has been historically in the pre-election year, but still quite substantially above 20 for some time, a little bit below that now. And you'll see that, the highs for pre-election year, and I'll just jump to that here, tend to occur at the end of the year. You see the green highlights where these clusters of new highs occurring in December, and a lot of them on the last trading day of the year. We've got lows in January and lows in October as the sort of predominant cluster there. So the average move from the midterm low, which we had on that Christmas Eve crumble of 2018, seems so far away now, doesn't it? But it was a point where everyone was worried about Santa Claus not showing up, but he did. And one of the reasons we continue to remain bullish this year, even though we've been defensive since spring, and even more so July when we got our NASDAQ sell signal. So a look at what the average gains would be if we went up 70% from the midterm low to the pre-election year high, 10,540. Not crazy. We didn't get that close to it, but at least we've made a run at something like that. I think we've got a chance to get to new highs again at year end. Don't suspect we're going to hit 30,000 yet this year, but we'll get close. Maybe if we get a nice rally, maybe we'll get a trade deal. And this impeachment thing doesn't have as much teeth as people are on the opposition are hoping for. Anyway, a look at the 2020 Almanac, a little preview. One of the things that drives cycles, especially the 4-year cycle, is the power of incumbency. Unlike any other nation, we have a regular election at the same day every 4 years for the leader. No parliamentary votes and no confidence here. And just a reminder, and this is one of the things when I put the Almanac together over the summer that had us thinking more bullishly than you would have imagined, considering the battle that we're seeing waged and we're expecting to be waged for the presidency. But sitting presidents running for re-election since 1949, the Dow has been up 10.1% versus 5.3% in all election years, versus the open field with no sitting president running for re-election, down minus 1.6%. So, this is an indication of how the government manipulates the economy to remain in power. And another reason we're expecting a trade deal at some point. Either he gets a good deal or he's forced to cut one because of the economy and the market. So just to look at where we were at last December, this was the Thursday before the Christmas Eve crumble. We put this out. Our best case scenario still seems to be in play. Trump did not get mullered, even though they're trying to Ukraine him now, I guess. But I suspect that this is going to be a lot of noise, and it may drag on for a while, and he may get impeached. I doubt the Senate will convict him, and we know what happened after that happened with Clinton. Was pretty good for the market. So this little scare here, or big scare, is probably setting up a decent buy. And this is the kind of stuff that we put out in the newsletter every year, our annual forecast. The January indicator trifecta. Assume many of you have heard of the January barometer, the Santa Claus rally in the first 5 days. Well, we stood on Yale's shoulders, the man who created those three things, and the Santa Claus rally being the last 5 days of the old year and the first of the new year. And we combined them all, and you can see the illustrious history, the reason that we remained bullish this year was the fact that when you have all three up, 27 out of 30 times, market continues to be up for a decent gain, and even the last 11 months after the end of January, up 26 out of 30 for 12%. It's been tracking that way. Couple of blemishes, 66 in Vietnam, with Vietnam, the bombing of Hanoi or Cambodia, and 87 crash, the 2011 debt ceiling shutdown issue, and of course last year's, I guess, Powell punt or something, or whatever he said that scared everybody that the market wasn't, that the interest rates weren't normalized yet. We'll be looking for that again in December, January, as the year turns and we finish the beginning of the year. Last week we put out our market at a glance in the newsletter. This is what we put out to newsletter subscribers, keeping an eye on the 5 main disciplines we track. Psychology, as I mentioned earlier, bullish advisors were quite frothy. Fundamentally, things are a little soft, but looking ahead, we want to see what the ISM non-manufacturing, the services industry does towards the end of this week. Testing support again here. We did not make a new high, failed that resistance. The numbers that I'm looking at, which you'll see on a chart in a minute or so, 28.15 on the S&P, and that's the cash index, not the futures. I spoke with Larry McMillan down in Philly at the Money Show, and he threw out the future number. I think he said 27.75 was a number that was significant in the futures. Doesn't show up as much on the cash. It showed up for me in a trend line, and we'll see that in a second. Monetary policy, they may end up having a cut again, but as of last week, before we sold off a little bit, the chances were a little bit less than certain that we're going to get another cut. Seasonally, everyone's afraid. October phobia is here. It's upon us. Glad to be talking to you guys on such a time. But remember that this is a great setup for the seasonal up move. And again, this will show up technically on the chart in a moment. The pulse of the market here, not looking all that great with the down Fridays, down Mondays in August. Looking for some better breadth, as we mentioned, with the advanced declines, not all that robust. New highs that were up there, but not really blowing my doors off, and new lows were low, but I'd like to see a lot more new highs. Again, we look at this down Friday, down Monday situation as being an indication of people selling. I think we had that a little bit last week. Monday was pretty rough. Yesterday was even rougher. And again, some of the technicals, the market internals that we track coming right out of the Almanac. Just a reminder of last month, the September Almanac. You can see October lined up here. This is right out of a shot right out of the Almanac, the one that Danny looks at every day. And you can see the plan. We're usually a little more bullish here at the beginning of October, but I think we probably got that mid-month sell-off a little bit earlier with some of the news flow. The last week of September, often the week after quadruple witching, or the quad witch, very negative week. You can see from 1990 forward, S&P down 23 of 29 of those weeks after Q3 options expiration, average drop of almost 1%. Different story in December, just ahead of Christmas, usually a very strong period with the Santa Claus rally. So again, a trading time of year to be very leery of and ready for it, and definitely looking for downside action there. October, second worst month in pre-election years, getting that right now. You can see the pattern again there, usually a bit stronger early in the month, but again, you'll see the pattern, I guess, in the next chart or so that shows what you can expect through the rest of October. Here's the one. I've put the word October phobia on there for y'all, just to remind you what we're looking at. You see this down period in October, probably pushed forward a little bit with the news flow. But looking back to the beginning of the year, the dotted lines are the current year, 2019. The blue is NASDAQ, orange is S&P, black is the Dow. And the solid lines are the history. Dow and S&P back to 49, the first full 4-year cycle since World War II, and NASDAQ since 71 when it started. And you can see we tracked this first 4 months pattern very closely. Again, May was negative as we had anticipated, coming after the big positive first 4 months. June had a nice rebound into the middle of July, almost topped on Q. NASDAQ a little bit later. We had our NASDAQ best 8-month sell signal, came out on a Friday close, July 19th. We put out the alert to our subscribers on Monday, early in the morning, and finished our move to defensive positions, which we still remain in right now. You can see the chop in August, quite typical, even a little bit more negative than we often see in the pre-election year. And then this peak around September triple witching, the end of September, that week after triple witching negative, as as it often is. And unfortunately, we didn't get our little first 3 days pop in October, but you can see that, the pattern for October is to probably test the support levels, move sideways through November, and then a new high at year end, as is often the case in the pre-election year. There we go. And here's my resistance lines. Some people give me a hard time about how many I put up there, but I see what I see and I draw them up there. The 2015 number was something that not a lot of people jumped on. It turns out, if you look to the right side, that it was the intraday high in November of 2018 before we fell through the floor and then had that December sell-off. 2725 is the number I think is a little more critical support that held in June and also around back in March. And this 2775 number that Larry was talking about is something that he's looking at. Of course, we failed at this to make a new high. We struggled to get through this 296 resistance, but 2815 looks like a strong area. I think what are we down at today? At 29 something. Let's just look on the old phone and see where we're at in this chart. I don't want to switch back to the other screen and risk losing you guys. So we are 2893, just below 2900. So we are getting into this level. The January 2018 high, 2875 is the number. So I think we're at some pretty important support levels. I have 2815 in my head, and then below that 2775. If we break that, I think we'll be in some more serious trouble. Fourth quarter magic, just a little reminder. We didn't get it all in the Q4 of the midterm years we're supposed to, but we did have a pretty strong first and second quarter of 2019, the pre-election year. Q4 2019, pretty strong, about 2.5%, 3%, over 5% for NASDAQ. So again, something we're looking at here. But election year, first quarter, not the greatest, especially for the Dow. But again, something to look forward to here in Q4. And I want to show you some other Q4 trades as I watch the Dow plummet 440 points, S&P 446, NASDAQ's down 118. Good trading day. So the seasonal pattern, we are living it right now. You can see October here, the black line showing you the long-term pattern from 1950. For the Dow, the green line showing you since the 87 crash when the circuit breakers came in. And just to disprove the naysayers, we have the first half of the last century when it was a farming society, pretty much buy in May, as you guys out there in the pits know. Action, with the growing season used to drive the economy when about a third or more of the country was involved in farming. Used to be buy in May back in the first half of the 20th century, from 1901 to 1949. So you can see here, pretty much trading along with the pattern, and our system, one of the only proven black box systems out there. I've had David Aronson, who wrote a book, Evidence-Based Technical Analysis, was our best investment book of '08. He put our best 6 month switching strategy, buying close October 31st, selling close April 30th, versus the buying end of April, selling the end of October, to be one of the only proven black box systems out there. Compared to about 6,000 other different algorithmic trading systems, using the scientific method. And unlike any of the others, best 6 months showed predictive power, and that the results, the numbers were not the result of chance. 7.5% in the worst, in the best 6 months, 0.6 in the worst. Just an example of compounding. 10 grand in the best 6 months gets you $1 million since 1950. That's a one-time $10,000 hypothetical investment in 1950, versus a gain of only $1,000. That's $1 million versus $1,000. Using MACD, and I know you guys all know about MACD. We use the 817.9 on the buy and the 1226.9 on the sell. Tops are more of a process. We use the slower, longer MACD, and bottoms are more of an event. We use the faster one. Improves the best 6 months to 9.1%. The worst gets worse to a negative number, -0.8, and it nearly triples the gains in that initial $10,000 investment to nearly $3 million. And the loss in the worst months turns that small gain to a loss in the worst months of $6,000. Just to keep us all honest and to take a look at more recent history, since we had such a banner worst 6 months after the '09 low in March, I keep track of what the best and worst months have done since then. And you can see that despite a couple of weak best 6 months and one really decent worst 6 months, or two or three for NASDAQ, it's still about 8.5% for the Dow and S&P, and under 2.5 for the worst 6 months, whereas NASDAQ's 10.5 versus just about 4.3. So it continues to work. We always compare long time frames for the seasonal patterns to intermediate time frames to short time frames, just to make sure it's been working and it's consistent for the long haul, and it's still working in the short term. Here's a look at our little chart with the MACDs on there. This is from Trade Navigator. I tend to like using their charts. I can pull up seasonal trends on there as well. This was just updated a little while ago. You can see we're falling down through 29 here, as we mentioned before. Still sitting between that 200-day and 50-day. The pink line's the 50, red's the 200. And looking down at the bottom, you can see we are now below our MACD sell signal on May 1st for the S&P. Also below for the NASDAQ, which I don't have here to show you. We did get a little drawdown, or a decent drawdown, from the October 31st buy. But this is one of the few things that we hold without a stop because of the seasonal pattern, the strength of the seasonal pattern. And this is, for the newsletter people, we put out recommendations on, the diamond, spiders, and cubes, and the Russells, DIA, SPY, QQQ, and IWM. And we held it without a stop. We stood firm there on Christmas Eve, and Santa Claus came to town. And then after we cleared the old level in about January 10th, we doubled down on those and held those through May 1st for the Dow and S&P, and then July 22nd for NASDAQ and the Russells. And then look down at the MACDs here at the lower part of the chart, and you can see where I'm starting to, get a little, I'm bringing my hands, I'm starting to drool a little bit here as we dip below that zero line, and we're sitting in our bond positions and our defensive stocks and staples and utilities and that sort of thing, and waiting for the equity markets to turn. And we're setting up for a nice buy signal below the zero line, another couple of days like this, and we'll be looking for a nice solid signal. If it keeps going lower, we're going to wait until we get a turn for the positive. And that's the purpose of using this MACD. I mean, MACD is a technical indicator used to confirm an entry or exit or a buy or sell. It's not something you use in a vacuum. So we overlay it on top of our seasonal patterns. And for the best 6 months and best 8 months by NASDAQ and the Russell, we start looking on or after October 1st for a new crossover. And April for the Dow and S&P, after April 1, we look for the sell. And then after June 1 for the NAS and the Russell. But this is playing right into our hands, and we're getting ready, bats on the shoulder, and we're kicking some dirt in the batter's box right here. So we don't sell in May. We don't go away. We do sell a few things. You can just see how we sort of reposition in May through July. We got out of our diamonds and spiders, as I call them, or spies and DIAs, whatever, May 1st. Get out of the Qs and the IWM, July 22nd. We moved into the bonds, which you'll see just the TLT has outperformed the market since spring, even more so than the broader bond indexes, the AGG and the BND. We got out of our financials and industrials and materials. And the transports, we actually have a short for the transports on right now that you'll see in a second. Healthcare's had a little trouble, but the utilities are doing well. Staples are doing well. We tightened up all our stops on our stocks, got rid of any losers or real underperformers, and a couple of them are stopped out, but we still have some decent stocks. I'll show you that list as we roll towards the end of this. And we put out a new defensive basket of stocks, a lot of dividends in there. UNH, United Health, got stopped out, but we did have AT&T and some other nice dividend producers. So, sorry, the tactical switching portfolio. And you can see that we've been in the bonds since April. I think we're probably, this is updated from our newsletter last month. I think we're probably back up to those levels, at least pretty damn close on today's past 2 days action. And you can see in the chart here, compared to the S&P, the 3 bond ETFs that we trade, again, back leading it. And, if you look at it from May 1st, I don't know if you can see my mouse on there, it's been a pretty steady, solid move through the worst 6 months, whereas stocks have gone nowhere, and now we're below that period. So, again, give you an idea how we rotate tactically in and out of the markets in different sectors. Speaking of sectors, this is out of the 2020 Almanac. You can see the red line up there. If anyone has a 2019, they know it's green. So we got a new color for 2020, and you can see the sector seasonality table here. The B is for the beginning of the month. The M is for the middle of the month. The E is for the end of the month. We split it up into thirds. And just you can see, we got a long coming up in biotech and high tech, and I'll show you we have some buy limits well below the market, which are looking more and more likely as this thing corrects. Transports we have on a short and got a nice trade there. Oil short did not work out for us with the drone attack in Saudi Arabia. And then all of the, not all, but almost all of the sectors come into their seasonal bullish period in October. And again, comparing 15-year, 10-year, and 5-year returns to give you an idea of, and that's an idea of how these different seasonal, trades for the sectors have worked over different time frames. Best performing sectors of the worst 6 months. This is where we concentrate ourselves and have been. We kind of stay away from biotech until later in the worst 6 months, because even though the average gain is high, the number of gains versus losses is not superly impressive, about 50%. But if you look at staples and utilities and some of the others, you see 80% of the time it's up with a solid average and median gain. And then at the bottom is materials, which is a pretty decent short during the worst 6 months. And let's just take a quick look at that on a 1-year seasonal pattern. Pretty clear how the worst months for utilities, May through October, and not utilities, excuse me, materials. and bullish season from October through May with a little January break, much like the one that you guys will see in the S&Ps on the futures market. And just a comparison of what it's like trading long, the best months for materials, and short, the worst months. That second rotation gives you 14% gain versus 5.8 for buy and hold. And again, comparing that 10,000 bucks is about a $400,000 gain versus just under 50,000 for buy and hold. The value and benefit of using seasonality in your trading. Our current sector rotation portfolio, you can see we did get stopped out of this ProShares crude short, the SCO, Biotech and Tech, the IBB and the IYW has not hit these almost long shot buy limit lows we put in there back near the old December 2018 lows. We had a short in the S&Ps in July, another short, seasonal short setting up right there right now, and we're in it for October. It's a little ahead of schedule with this selling we're getting right now, but again, seasonally, the S&Ps tend to drop here in October. And you can see we've been holding transport short, staples, utilities. The old live cattle trade that starts in June did not work out for us this year, but we will continue to have a look at things like that coming out of the old commodity almanac, which we're in the process of trying to put together for 2020. Here's the transport short, probably about where it was a couple hours ago when I had a look at this, about 181. And you can see we were shorting it looking to short it at resistance back in July, where the yellow box is around about 195. I think there, and we failed that resistance. We came up against it, but we had our stop back near the old April highs at 250 cents for the IYT here, and did not get stopped, and we are still short this and benefiting from the current selling on this particular trade. So we're targeting some strength here in the biotech and high tech, the NASDAQ IBB and the iShares IYW, the high tech. Just to look at where we put these buy limits, kind of gutsy, but we figured since we're expecting a bit of a fall correction, that if we put it down really low and we got it, we'd be pretty pleased owning it down at those prices. If not, we'll reevaluate, and either when we get our MACD buy signal for the best months, we'll go in and pick these up, or we'll raise the buy limit up. Biotech's definitely correcting quite a bit more here, so looks like we'll find an attractive price for that. Great, industry of the future, gives you a nice opportunity to get into it seasonally. The January effect, looking a little bit further out to the end of the year. It's a nice trade for some more active traders that we have here. We call it the only free lunch on Wall Street, looking at bargain stocks that are making new lows in triple witching in December, or quadruple witching, forgive me. I know you guys are more keyed up on the single stock futures than myself. But you can see that the small stocks of the Russells really start outperforming. They used to have the January effect, which small caps outperformed large caps in January. We're seeing most of that take place in the end of the last 2 weeks of December, last half of December. And you can see a lot of talk about how small caps have been underperforming recently. It's kind of seasonal and not necessarily so emblematic of anything that anyone wants to try to correlate with it. But basically, small caps tend to underperform until late October, and really don't start outperforming until mid-December. So our free lunch stocks did quite well. And this is a quick trade. You can see some of these were in and out pretty quickly. And what we do on triple witching Friday, again, quadruple witching Friday in December, is take all the stocks making new 52-week lows on that day. It used to be stocks making new 52-week lows on December 15th to outperform the New York Composite. By February 15th, we found that over the years, it's been the tax loss selling has continued to just before Christmas. So we get all of the volatility and action associated with the quad witch. And then we get Saturday morning to have a little quiet time to go through the list and weed out any glaringly odd things. We're only doing common stocks that have liquidity. I think it was 100,000 shares this year and over $1 on NASDAQ and the New York. There was nothing on Amex for us this year. And we use a window around the stocks. Once we find all these stocks making new 52-week lows, we take, once we get rid of the thin, cheap stocks that you're not sure what's going on, and all the ones that aren't just straight common shares that have been around for a year with no funky splits or dividends or anything like that. We take the ones that are down the most, and these are all over 70% down. And the rules were 2% window, so we weren't buying these the next trading day unless they were within 2% plus or minus the closing price on Friday. Which, so if it's down, things are obviously still awry. If it's up, we missed it. And then we had an 8% trailing stop. Might have been a little tight for a couple of them, but again, up 25% in, on average, a few weeks. Last ones we got out of were March 1st, as you can see in this list. So a decent basket of stocks to trade. Great trade for sophisticated, nimble traders like yourselves. And then just to wrap things up with what we do and leave some time for some Q&A, our stock selection process, in addition to the seasonals, we're not putting out a new stock recommendation every month like a lot of services do. We're looking at new stock recommendations at the time of the year when it's most beneficial to be buying stocks. Again, you saw our defensive basket. We put that out around the end of the best in 8 months, looking for some safe harbor places during the volatile worst months, especially August, September, and October, which we're experiencing now. And then around this time, we look for a basket of like growth stocks. So we use the Zacks Research Wizard, about 24 or so different criteria we're looking for: revenue growth and earnings growth and acceleration, good valuations, PEs and price to sales ratios, and that sort of thing, comparatively to the S&P and the sectors themselves. And one of the things that we really track is insider holdings as well, but ratings. Not what the Wall Street firms are rating the stock, but how many of them are following it, how many of them are putting out ratings. So all things being equal, we're going to take a stock, there's 2 stocks that one of them has 20 analysts following it, and the other one has 5. Everything growth, acceleration, and valuation wise the same. We're going to take the one that has 5 or whatever, the smaller number of ratings and Wall Street analysts following it, and try to get in ahead of the street, finding out what we're seeing in the stock screen, the fundamental screen that we look at. And we also use old school technicals, chart patterns, support and resistance. And we invert that in the short side. Not every year we're just going to put out shorts. We're not married to having a short every year, but we'll break it down into 3 market caps. Under $1 billion, it would be small cap. 1 to 5 billion is mid cap, and over $5 billion would be large cap. So again, seasonal overlay, October long, summer shorts. We look for sector seasonality and strength, and we want to see stocks that are doing well, that are underfollowed, or stocks that are overvalued and overfollowed on the short side. Again, here's the defensive basket that we put out back in June. Just to look at the kinds of stocks. We went out there, a bunch of utilities. United Health, we're out of. AT&T, we got a little boost from the news, just as an example. Some staples in there, a little healthcare, medical, and looking forward at our current portfolio, not a single small cap in there right now. That's probably going to change in the next couple of weeks with putting out a new October buy baskets, new stock basket there. Our mid caps, a couple of them ran away from us. One of them got stopped out. And then the large caps, you'll see United Health stopped out. AT&T did quite well. One of them got canceled. We've got a few lingering ones from previous years. Again, one of the keys to investing, at least with this kind of stuff that we do, is letting your winners ride and selling your losers short. admitting error and getting out of things is one of the hardest things for anyone to do. As I know a lot of you guys are aware of that and know that. So again, we like to think that studying market history can produce gains. It has produced a bunch for us like these. And the stocks, United Health has done well for us. Arista Networks, a sleeper cloud computing firm that came through our screens. Church and Dwight, a big staples company from last year, and even our sector trades down below. Most recently, the TLT up over 19% and counting right now. So here's what our portfolio of stocks looks like at the end of June. We're going to be updating that for the end of September shortly, but 507% versus 140 for the S&P and 200 for the Russell. And you can see currently, as of last month, we were up 504.4 versus 147 for the S&P. So if you want to come in and join us, you get a free almanac every year. You get all these targeted strategies for growth stocks and dividend income stocks, lots of updates and analysis, trading, investing ideas, and we give buy limits and stop losses. I don't know if you caught some of that. I'm trying to run through all this. We get some questions, but not a lot of companies, not a lot of market letters will give you a stock and a specific buy limit and stop loss, or tell you when to sell it. And that's one of the things we pride ourselves on doing. Next couple of weeks, we're putting out a new stock basket. Of course, you'll get our MACD buy signal coming up sometime after October 1st or moving forward. The only free lunch on Wall Street, those bargain stocks making new 2-week lows. All of the stuff that goes on in the Almanac, we update that every month in the newsletter and make it fresh and current with what's been going on, because we write the book. I've written about December 2020 already in the Stock Traders Almanac, and that's 18 months out. So we're going to be talking more specifically in the newsletter about what's going on in the Almanac and what to look for. So again, if you guys want to kick the tires, join us for 30 days free. You can use this link right here, or if you want to email me or reach out or text or Twitter or whatever, private message me something. Or if you're interested in taking us out for a year subscription, there's a couple of codes right there. And if you want to get the slides to go through again, I'm happy to share them with you. And I think that's what I've got for you. So let me jump back over to the chat room and see if I've got anybody who wants to ask any questions or make some comments. So that's it for now. And I'm over in the chat. Let me type something in there. And you guys can still hear me? Thanks, John. So, Danny, what happened while I was talking? It was hard to watch the market. I'm going to put the MACD chart back up, post a link in the chat. Oh, look at that. I'm happy to do that. Maybe I'll try.
I think there's abundance of stuff going on here. You got that, on the 10th, you got the China trade deal coming up. I think the president's under pressure to get something there done. You got the earnings coming up, and there's an expectation that, a lot of these big companies aren't going to produce the kind of returns that they've been returning.
Warren Surgeon.
What's that?
Warren Surgeon.
Oh yeah, Warren Surgeon in the polls. I don't know.
That doesn't make Wall Street happy.
No, in fact, I think there was something that was put out that said that Wall Street wouldn't back Warren if she did become the Democratic candidate. But I go back to one thing, Jeff, and really, maybe this is just a lot of shit hitting the market at the same time.
Yeah.
But I've learned from you, and I've learned from Marty and I've also learned from being on the trading floor that October tends to be a very turbulent month. I don't know. I looked in the Almanac the other day, and from 1929, the flash crash, literally, I mean, October, it's not that the flash crash was in October, but I'm just that there's so many different crashes in October that I think the market's just spooked.
Yeah, I mean, you don't think the frothy sentiment and the technical, sort of resistance had any impact on this?
Well, I do. And one of the things, the other part about this is after being around the pit bull for all these years, and again, like you said in the beginning of the presentation when I first met him, he told me one of the best things that you can do is follow historical stats, and that's when I picked up on the Stock Traders Almanac. But I can sense in his voice over many years of being around him, and listening to him, that he was really concerned in the middle of September, maybe even a little bit earlier in September, that October could be like a critical down month. And he's told me, and he was actually in the office last Friday, loading up on spider puts. And I just know that, I think there's a lot of concern about here. The S&P's up, 350% from the credit crisis low.
Mm-hmm.
The Fed, some of this economic activity may force the Fed to lower rates when they don't want to. And I think that that's a big concern. I also kind of get this feeling that this watered down trade deal, that also may not be a very big positive for the stock market. So, October better than anybody, and we're starting out on it.
And that becomes this whole self-fulfilling prophecy.
Yep, it sure is. And I was telling the guys in the office that, over the long haul of reading the Stock Traders Almanac and talking to you, that historical stats matter. I mean, it's just another tool in your toolbox. And
Yeah.
I would suggest that anybody in the workshop take that free month from you and use that thing. Just add it to what you're.
There's lots of trading ideas in there. We put out commodity seasonal trades, and while I might put a correlated stock or ETF in there for a retail-oriented person, there's plenty of action that you guys can do. Your own trading strategy, your own option strategy, or what have you.
Yeah, well, I mean, I think a perfect example was, at the end of the year, the end of last year, when December, when the stock market started, did it start selling off in September? I can't remember. Was it October? Or, we had that big sell-off, and then the Santa Claus rally at the end of the year after the December 26th. It came
it's on my chart that's up there.
Yeah.
Actually, it's better on this one. I kind of highlighted the recent sell-off in the summer where we held support as opposed to last year when we broke support.
Right.
There was a whole battle thing back then.
Oh, it was unbelievable. It was right on, too.
Somebody asking a question over in the chat. I'm going to get back to
Okay.
it.
All right.
Okay.